You're watching Famous Dave on YouTube.
Hi, you're watching the Shortfall Show live on YouTube. And this morning we come into the day with the markets down a little bit, the VIX up a little bit. And if you're like me, you're kind of tired of just listening to all this political stuff. It's like it just keeps going on and on and on. Let's just get this over with and the inauguration and see what happens after that with the markets. But I wanted to talk about something. I've got an idea for the VIX position, and tell me what you think about it. I kind of want to simplify things, and just since we're starting the year out with a fresh slate, maybe just start by having just the most conservative position in VXX to make money, even if it's just a little money, even if it's just a little bit of money. Just reset the position, go away from being long a bunch of puts, and maybe just sell one or two out of the money calls. Let the expiration week go by, collect that money, and move on. Just sort of a proof of concept thing that VXX can make money instead of getting too complicated by picking, which put you want way out of the money. Maybe just sell a few calls or call spreads and put up some wins on the position. Let me tell you what I'm talking about here. If we look at a position here, a potential position, if we go to VXX and we look at the chart, here's the VXX chart here. You can see it moving sideways for a long period of time. We know it will slowly move lower. We are currently still in a pretty good level of contango. Remember, we've got expiration next week in the VIX front month futures. And if we pull up VIX Central, we can see we've got a good level of contango, and we already have a pretty good head start as far as moving into the next relationship between, as the January future comes off the board, as we start to look to the Feb future as the front month, and then March coming up, we can see here that there is already a good relationship developing between Feb and March. We've got 2% contango already, and that will only continue to grow as we pass expiration. You can see right now the front month future slightly inverted with spot VIX price. Now, since we are close to expiration, the futures will kind of hug the VIX cash or the VIX price. The front month future will stay real close to that because it has to be right on the dot there pretty much on expiration. So if we were a couple weeks out, you would see a bigger distance between these two. But since we're coming up on expiration, these kind of hug each other. Also, with the little pop in the VIX has moved up to kind of meet the futures, and it's past the front month future a little bit, so we're slightly inverted. But 8% contango, as the VIX moves back and forth up and down, staying at that 8% is going to continue to decay these products. But I was thinking about, just as a sort of basic sort of proof of concept type idea with this VIX ETP here. This is an ETN VXX, but if we were to, for example, go out 2 weeks and look at some options here, if we were to maybe just go out 2 weeks and maybe just sell, what if we were to go 2 weeks out, sell 2 of these January 22 calls at 50 cents, right? And that was our position. And we wait 2 weeks, and assuming we don't have some sort of major crash, we collect that 2 times 50 cents or $100, and we move on. We put that in our bank account and we move on. Now, certainly this could spike through 22, but this would be a good odds-on trade. Now, you're not making tons of money. You're making $100 over 2 weeks. However, it's a positive in the account, and we can start the year off right with a positive in the account and move forward from there. My point being, let's use this account in real time and watch it together to demonstrate making money, as opposed to what it's been demonstrated over the last couple months with this account, which is basically, leaning short, and then we've moved sideways, and thus all that's really happened with this account is we've paid that theta decay every day, and it's lost money because we've paid the theta decay, and yet net VXX has gone nowhere. So if we look back on time here, you can see VXX pretty much the same price it was back on November 30th. It was $16.99. And then right now we are right around $16.86, right? So really hasn't gone too far. You could even move back here. Actually, that was 18. That was a little higher. So it has slowly moved down, but really not a lot of progress. If you think the position I had on, if you think each of these days, each of these little changes between gray and black is one day, and if you think each of these days costs $30, right? And that doesn't sound like a lot, but we got a lot of days strung together. There's $30. 10 days is $300, right? 100 days is $3,000, and so on and so forth. And meanwhile, nothing's happened, right? We've just moved sideways. Now, we are slowly moving down, but we're not moving down fast enough to cover the decay. So if we had been selling calls each week, if we'd been selling $200 worth of calls each week, then we would have made, 200 this week, 200 that week, 200 that week, 200 that week. That would have been the better thing to do. So maybe we go back to the drawing board on this position and we just do a real conservative trade, maybe sell 1 or 2 calls. We could even not go out 2 weeks. We could go out 1 week maybe, right? And just sell. What if we sold 2 of these 18 calls at 50 cents, right? A week later, if and our game plan would be we sell 2 of these calls. If VXX is above 18 on expiration on next Friday around, 233, then we roll this call to the next week 18 call. If VXX is way below there, then we buy these in for a penny, or we let them expire worthless. Now, generally, if we're anywhere near the strike, I would want to buy these calls in for a couple pennies and not risk that, something crazy happens right on the close on Friday, and all of a sudden I'm getting tagged, right? But that's more of the nuts and bolts of it. But let's consider, and you guys can tell me if you like this idea or not, but let's consider just as far as this public position is concerned, just going way back to basics and just having a very small position that is the odds are in our favor of this working out for us. So how do I mean the odds are in our favor? Well, what's the delta of these options? So let's say we went out 2 weeks, right? And we looked at this call we were talking about, the 22 call. All right. If we look here on the screen, the delta is 20, right? So if that means that there's a 20%, or it's 21. So that means there's a 21% chance of this option finishing in the money. Conversely, if you take 100 and you subtract 21, right, you get 79. So there's a 79% chance that this trade works out for us. So that's putting the odds in your favor. A, and B, if it doesn't work out for us, then what we will do is we will roll this to the next week. And as more and more weeks go by, the odds just continue to stack up more and more in your favor. The reason I want to do this is because I want to prove that this trade works out. And I haven't been doing a good job of that over the last couple of months. We've been kind of stagnating here, and really not a lot has happened P&L wise for this account. There's money here, and we could have been using the money on something else. Instead, we've used it on this, and it hasn't worked out for us. So how do we remedy that situation? Well, sometimes you just got to change up. Now, of course, there's a risk that as soon as we change up the position, all of a sudden, the the VIX goes to like 16 and these puts that were long right here explode in value. So that's the risk. So we want to want to kind of muse this out a little bit and decide what we want to do. However, I kind of like the idea of just putting a couple wins up on the board here, and working from there. Now, I just want to give you some disclaimers here. Selling naked calls, is not something that you want to do unless you are comfortable with the risk. Remember, when we sell a call option, we are giving somebody else control over 100 shares of this, right? So VXX, you might not think it's valuable to have control. Essentially, if we sell one of these 22 calls behind me here that I have highlighted, we're giving somebody the control over 100 shares of VXX should VXX go through 22. And you might say, well, it's not very likely that it goes through 22, and that's true. However, unlikely things happen all the time in the stock market, and you don't want to take it lightly, giving someone control over 100 shares, right? Because this could potentially go from where it is now, around 17, it could double, right? And in which case, you would lose some money if you're selling these shares. So let's just very quickly do a little analysis of what it means to sell 2 calls. So what I'm going to do is I'm going to pull up on the screen my Analyze tab here as we get the bell. And we will model this. It's good to just play these things out and see what it means on a chart and whatnot. So what I'm going to do is I'm going to go and I'm going to model selling 2 of these calls. So I'm going to I'm on my Analyze tab. I'm going to go to the second week out. I'm going to pick the 22 call, and I'm going to click on the bid, and that is going to put that into my Analyze tab. And indeed, when we look down here, we've got selling 1 of these calls on our Analyze tab. No, we were talking about selling 2, so let's change that to 2. All right, so now we can see our delta is we're short 47. However, if this was to double in price, I've got this listed here. If it were to double in price, we would lose $2,300, and we would have to have $57.78 set aside in our account to cover the risk of this trade. So our buying power would be reduced by $5,700, and we would have lost $2,200. Now, when you sell these calls, it doesn't seem like a big deal. It's like, well, it's very unlikely that it's going to go there. However, you can see the consequences here are pretty severe. If we went up 100%, we would lose $2,000, right? So just to try to make $100, we're risking losing $2,000 if this goes up 100%. Now, the likelihood that it goes up 100% is fairly low. However, it still is there. And you can see that even just selling 2 calls naked is a real risk that you need to contend with very seriously here. If we were to change this to 10 calls, oh boy, all of a sudden, look at this number here. If we sold 10 calls, right, that would represent, a $500 win over 2 weeks if this came to fruition. However, up 100%, we get a big spike. All of a sudden, we lose $11,000, and the account is completely blown out, right? Just selling 10 calls, we could give all the money in this account away and actually owe almost $4,000. Owe, $3,000 something dollars. Well, let's see. Let's call this $8,700, right? So basically owe a few grand just because we sold 10 calls to try to make $500. So this modeling stuff is crucial to do ahead of time, and selling a naked call is not to be taken lightly. If you take anything away from watching this video today, take that away. Selling a naked call. Now, selling a naked call, however, there are some huge advantages to doing that, in that it's a fast decaying option. It's pretty unlikely that will happen, but there are serious risks involved with that trade. In fact, even though this trade that I currently have on, being long all these puts that are far out in time, you're going to see these consequences to the P&L. You can, when we model this trade I have on now, which is long some SEP and Jan puts, you can see it shows short 800 deltas. You can see the P&L moving around pretty drastically just for a 1-point move in the underlying. However, in many respects, being long puts that expire months and months and months out is less risky than selling naked calls, because you've got all this time for this to come back, right? You just, if money flows out of the account, you've got time on your side, you've got contango on your side, you've got all these things on your side for the money to come back into your account. However, selling a couple naked calls that are close to expiring, if you sell 2 naked calls and we spike 100% next week and you lose that $2,000, that's not, it's not, you don't have time to wait for the stock to go back, for the underlying to go back down. Now, certainly you could maintain a short delta and roll the calls out. However, it is a different sort of trade to contend with than being long these puts that you can kind of just leave and just look at every couple days or something like that. So these are decisions that you have to make for yourself as a trader. And indeed are things that shouldn't be taken lightly. Most of the trading I've been doing with this particular account has been kind of mid to long term. And one of the things that that I see myself doing wrong with this account is to what I would call churning the account, which is to make too many trades, to switch strategies too often, and to not just be disciplined and stick with one strategy. Now, part of that I could explain away as trying to demonstrate to viewers different things to do. However, in the end, what's more important, to demonstrate to viewers different things to do or to make money? I guess that that has to be something you decide for yourself. But I mean, this is a relatively small account, and if I can demonstrate to people and teach them how to make money themselves, then that's sort of more important than generating profits on the small account. However, to do both at the same time would be obviously the ideal. So I want to apologize to Ilya for I still haven't put up the interview that I did last week. I want to get that out there very soon. And we'll see what happens here. It looks like we're kind of coming back after the open. Let's take a quick look at the E-minis overnight. We've got, we were basically down a little bit the whole night here. Here is a look at a 90-day, but let's close up a little bit to the action overnight. And you can see kind of off the lows of around midnight. And really just kind of sideways action here. Yes, we're down a little bit, but we've essentially been moving sideways. You can see VIX futures up a little bit. We are still inverted between the VIX and the front month. However, that will probably sort itself out as we move through the day here. And we will see what happens moving forward here. But really not a whole lot going on in the markets as of this moment. Anyway, so that's your update for now. Tell me what you think about maybe taking this account and just going right back to basics and like selling one call and proving that we can make money selling one call and then moving on from there. I kind of like that idea as opposed to just sitting on these puts that are just decaying and decaying and decaying away and slowly just kind of like whittling away at the account value is, it's not fun. So maybe something new needs to happen. Of course, as soon as I switch the position, we will inevitably move way lower in the VIX, but that is just life. All right, let's check in really quickly with everybody. How's it going? Dave, what about defending, rolling the position? I assume you're talking to if you were short calls. You could definitely do that. Good morning, everybody. I'm holding UVXY 16, which is a 35% down. But folks, there's a chance Trump is serving second term. Don't think it will impact the VIX that much. I read about contango, but I still don't understand it. I don't think I don't think it's very likely that Trump will be serving a second term. I don't see how his path to that is. He doesn't have a clear path to serve a second term, so I think it's probably time to accept that he will not be serving a second term. However, politics aside, contango, Christina, is all contango is it just describes a relationship between two futures, right? So if we go back to the term structure chart here and we look at it, we can see here that I have to pull up my screen here and make sure I'm out of the way. Okay, so we can see here, if you look at these two futures, let's erase that. Get a new chart here. Okay, so if we look at these two futures, right, all contango is let me see if I can make this bigger. Okay, all contango is saying that this is sloping upward, right? So if it's sloping upward between the futures, then that's contango, right? If it's sloping downward, it's called backwardation. And it's really hard to see my pen on here. But anyways, that's sloping up. If it's sloping this way, that's backwardation. And that's all it is. Now, in this case, the way contango is decaying UVXY is that every day UVXY rebalances. And actually, to explain this accurately, there is an index that is based on the moving average of UVXY, and the index takes into account the fact that the back month future, the Feb future in this case, is higher than the Jan future, and thus, as time goes by, what UVXY represents, the level of futures that UVXY represents is moving higher. So when you have contango, as time goes by, what UVXY represents is a higher and higher VIX. And the problem with that, and the reason why UVXY goes lower, is as the VIX moves back towards the mean, which is 20 or below, having UVXY represent a higher and higher VIX future means that UVX has to fall farther to get back to the mean. So essentially, just to think of it in the most basic terms, it's not entirely accurate, but it will help you visualize it, is that UVXY is slowly decaying by whatever the contango is. So right on the screen, we see contango of 8.35%. That means per month, UVXY's value is slowly deteriorating. So when you're long UVXY right now, you've got this decay from contango that's hurting you. It's going against you. So you need something to happen in UVXY for the price to A, maintain where it is, and B, move higher. I'm sorry that you're down money since the election. I generally try to tell people, and the rule of thumb I follow is don't hold on to UVXY for more than 48 hours at a time. If it doesn't work out for you in 48 hours, get out of it. You can always get back in later if you, if you see another opportunity. However, holding on to UVXY or VXX over time does not work because it slowly moves lower. Now, sometimes you're going to pull up this term structure, which is at VIX Central. Sometimes you'll pull this up, and instead of having it slope up like this, it will be just kind of flat. It will just slope totally sideways. And when it's just totally flat, instead of sloping up, then you don't have as much decay going on, and you've got less to fight against for UVXY to move higher. Now, certainly, if the market were to tank today, then UVXY would immediately move higher, and so would VXX. However, long term, it has these things like contango dragging against it. The other thing that UVXY has dragging against it is that because it is a leveraged ETP, all leveraged ETPs have decay from what we call beta drift. Now, there's a certain path that UVXY could take where the fact that it's leveraged would actually make it move higher day to day. But in general, because it's a leveraged product, it does have decay from also beta drift. Now, UVXY is only a 1.5 times leveraged product, so that actually suffers a lot less decay than even a 2 times leveraged product, and way much less decay than a 3 times leveraged product. If you were to look at famous examples of like DGAS, UGAS, these are leveraged products that also exhibited decay in the past. And if you look at any 3 times leveraged products, both the one that is a bullish product and a bearish product, they both go down over time just due to this decay. And there are several videos on YouTube that kind of illustrate this as well. But it's just something you want to be aware of. Contango does cause decay in this case. Contango causes decay, and the reason why it causes decay is just that the nature of the VIX products is that the formula for a VIX product is that they need to sample volatility 30 days out, and the way they do that is by making a mix of futures. So futures decay on a specific date. So when you have a future that has 30 days till expiration in the VIX, then that's the perfect future for UVXY or VXX. However, it might be the perfect future today, but tomorrow, all of a sudden, it only has 29 days till expiration. And now, instead of having that one future to represent UVXY, you have to have 29/30ths of that future and then 1/30th of the next future out. And so because of the fact that we have to keep readjusting the mix of these futures, that readjustment or that redesignation of what UVXY is made up of is what causes contango to decay them. So essentially, without having to know all the nuts and bolts of it, just know in your mind that the higher contango level, the more you have working against you at any given moment to be long UVXY or VXX. Now, there's a ton of videos out there that are going to tell you why it's costly to be long UVXY or VXX, but essentially, it just kind of makes sense. Nobody's going to give you a free ride. If it didn't cost anything to be long UVXY or VXX, then people would just be long them all the time, and then you just buy VXX and you just wait for that one down day, and you're going to automatically make money. And as we know, there's no real free money in the stock market. So what happens is that, yeah, you can get long UVXY, but if you're not right right away or soon, it's slowly going to go down and go against you. And that's just the price you pay for trying to bet on this, using this product to bet on a down move in the market. So I understand the trading concept that, for example, Christina has. Her premise is that the election is going to be overturned. It's going to cause volatility in the markets, and thus you get long UVXY anticipating that event. Now, that whole premise as an idea for a trade makes sense. The thing that you just have working against you is that you need to be right in it. You need to be right, first of all, and second of all, you need to be right in a specific time period. Otherwise, it just continues to move against your UVXY and whatnot. At my situation, when do you think the next pop in UVXY could happen? I don't have any special insight into what's going to happen next in the market. When you first start trading, it's easy to fall into this idea that like there's some people out there, smart traders that are working for Goldman Sachs or something that know what's going to happen next, and they always know what's going to happen next, and they put these positions on because they know what's going to happen, and they make money every day. The truth of the matter is nobody knows exactly what's going to happen next. There's no way of telling when the next spike might be in UVXY. Some event could happen that that you would think would spike UVXY, and it wouldn't. Other times we get a spike when it seems like nothing's really going on. Like we'll be in the market one day, and all of a sudden stuff will just pop when there's seemingly nothing going on. If we look back at the VIX, even 180 days here really quickly, there was a pop in the VIX a couple weeks ago where like it didn't seem like anything at all was going on, and all of a sudden the VIX just popped. I think, in fact, this most recent one right here, there wasn't a whole lot going on, and all of a sudden it just pops for almost no reason. So it's very hard to time these things day to day. My advice to once again, I can't tell you how to trade. You've got to make your own trading decisions based on your own thoughts. However, I keep the rule of thumb that I don't stay long UVXY or VXX for more than 48 hours at a time, just because they decay. I would consider it very risky to have a portfolio that has a significant amount of your portfolio is long UVXY, just because markets trend higher over time. If we look at the stock market over time, it slowly moves up, right? So here's the stock market this is the E-minis over 3 years. It's slowly moving up. When you get long UVXY, you're essentially betting that the market is going to move down, right? So you're putting the odds against you. And over time, if you're betting just 1 day or 2 days, certainly we could have a down day. However, the longer period of time that you put the odds against you, it just comes to fruition that you're going to eventually end up losing. It's like the number of occurrences. If you have one occurrence, certainly you could have a down day or a down minute or a down hour. However, as the number of occurrences goes towards 100, 1,000, a million, the odds are eventually going to be realized. So, yes, if you're long UVXY and you get a huge down day, you could make a ton of money. Yes, certainly tomorrow UVXY could double in price. However, the odds are against you, and the longer you hold on to that position, the more likely it is that the odds actually come in. So that's all I really want to say about that position. You have to make your own decisions trading-wise, of course. All right. Thanks for watching, folks, today. I appreciate your questions, and we will see what happens moving forward. I'm just tired of listening to all this political stuff. It's exhausting. It's all very exhausting. Best of luck this week. Let's see. More comments. Google UVXY for losing value. No problem, Christina. Thanks for tuning in. I appreciate you. I hope people learn a little something here today. Have a great rest of the have a great weekend, folks, and I hope everybody who's watching here makes money. That's my hope for all of you. We'll see what happens with the position today.
You're watching Famous.